Yeah. Hello. Yeah, let's move on to the next topic, inventory valuation. Normally, when we say inventory, we include raw material, work in progress, and finished goods. And inventory is a place, inventory is an item that will come in both trading account and balance sheet. So it'll have an impact on financial result also and financial position also. Therefore, inventory valuation plays a very important role because if you don't value the inventory correctly, your entire financial statements are misleading. And for that reason, there's a separate accounting standard issued by ICI. This accounting standard 2 deals with inventory valuation. Now, this entire chapter will be discussing some three or four important topics. So, without wasting much time, we'll directly get into the important topics from examination point of view. Now, first, methods of inventory valuation. So, how do you value inventory? For this purpose, inventories are classified into two types: not interchangeable, interchangeable. When we say inventory is not ordinarily interchangeable, normally these are the items which are huge value items and these can be identified separately. For these kind of inventory, we follow something called specific identification method. Only a theoretical name you just remember. We don't expect any problems on this method. The other item is inventories which are ordinarily interchangeable. For this, either you can follow historical cost method or non-historical cost method. Under historical cost method, we have first in, first out, loss in, first out, simple average and weighted average. Under non-historical cost method, we have adjusted selling price method, or this is also called a retail inventory method. Okay. From examination point of view, the simple average method is not very important, so we'll not be discussing that. So let us discuss the remaining four methods. Okay. Now let us move on to the first one, first in, first out method. See, in first in, first out method, what is the assumption? Whatever is purchased first, that will be sold first, which means the closing stock is normally a part of the latest items that you have bought. Correct? So let us take up this question. Some information is given to you. Opening stock, purchases, issued for consumption, purchases, issued for consumption, issued for consumption. For this particular question, let us try to find out the closing stock under FIFO method, LIFO method, and weighted average method. And whenever they ask you to find out the closing stock value, we prepare a statement called stores ledger cart. In chronological order, let us first do FIFO method. This format will start with the date of the transaction. Under purchase, we have quantity, rate, amount. Sales again, quantity, rate, amount. Balance, quantity, rate, and amount. Opening stock, we don't have it. Then on 1st of January, there is a purchase. What is the quantity? 100 units, rate is 30. So 100 units, 30 rupees, amount is 3000. And whatever we bought also will come in the balance column. 100, 30, amount is 3000. Next. Then on 15th of January, there is an issue for consumption. So treat that issue something like sales. Issue is nothing but as a manufacturing company from stores department, we issue to production department. For time being, whenever there is an issue, treat it like sales. Out of 100 units, how many units are issued? Can we say 50 units? And the rate of one unit is 30, so 1500 is consumed. So can we say the balance left is another 50, whose cost is 30 per unit, 1500. Okay, next one. On 1st of January, again there is a purchase of 200 units. Can we say 1st of February, I'm sorry. 200 units costing 40 each, total is 8000. Now, when you maintain the balance column, you maintain lot price. Can we say already we have 50 units at 30 each? In addition to that, we have got another 200 units at 40 each. So you need to maintain that lot wise so that you can keep a track of what is there with you. whenever there is a purchase or sale. Okay. Next is on 1st of February. Then on 15th of February, issued for consumption 100 units. Now, in FIFO method, our assumption is whatever is purchased first, that will be issued first. So that 100, can I say, would have gone from 50 from here. So 50, 30 each, 1,500. And the remaining 50 I would have taken from the second lot, whose rate is 40 each, that is 2,000. Now in the balance column, can I say out of 50, this is totally gone, and out of 200, 50 is gone. So 150 units, 40 each, 6,000 is what is remaining in the balance. Okay. Next one. On 28th February, again issued for consumption another 100 units. So this is on 28th Feb. Another 100 units. Can I say this entire 100 will be from this 150 only? So 100 units are issued from here. The rate per unit is 40, 4,000 gone. So can we say closing stock here 50 units costing 40 each, total amount 2,000. Is that clear? So this is how you prepare stores ledger card under FIFO method. So the final closing stock value should be 2,000. And if they ask you what is the cost of material consumed, total of this 3,000, 5,000, 9,000. This 9,000 will be cost of issues or cost of sales. Yeah. Now the same question, let us try to solve under LIFO method. So can we say first two transactions? No, first three transactions is going to be same, not much difference. We'll directly discuss from transaction number 4. Yeah. If you look at transaction 4, on 15th of February, 100 units are issued for consumption. Now, when we follow LIFO method, whatever is purchased last, that will be issued first. So that 15 Feb, 100 units will be taken from the latest lot from here. Just can I say 100 units, 40 is the rate, 4,000 is the amount. And the balance column, what will be the approach? Can I say this 50 into 30, 1500. And out of 200, if 100 is utilized, another 100 will be left into 40. This is what is left. Next. On 20th February, again another 100 units are consumed. So can we say this 100 would be taken completely from here? So this 100 units is taken care. And the rate is 40 per unit. 4,000 is the amount. So now the closing stock left will be this 50 units whose rate is 30 per unit. So can we say the closing stock value will be 1,500 as per LIFO method. Clear? Now, moving on. The same question, let us try to do as per weighted average method. Weighted average method is a very simple method. Here what we'll do, can we say first two transactions same, opening balance is there, then we have some purchases given. We'll directly discuss from the third transaction. Okay. See, in the third transaction, we purchased a 200 quantity costing 40, amount is 8,000. Now what we'll do directly, in the balance column, already we had 50 units. Now you bought another 200 units. Now you don't maintain lot wise, you just total both. So can we say the total quantity available is 250? The total amount will be 1500 plus 8,000, 9,500 is the total amount. Now you do total amount 9,500 divided by quantity 250. That will give you 38 rupees rate, which is called a weighted average rate of 1 unit. Next, on 15 February, we have issued 100 units. The rate of 1 unit will be taken as 38, 3,800. And again on 20th February, another 100 units. The rate is 38, Amount is 3,008. So can we say out of 250, 100, 200 gone. So now the closing stock will be 50 units. Rate is 38, 1900 will be your closing stock. Which means in weighted average method, we need not maintain the items lot wise. We just take the total quantity and total amount, find out the weighted average rate. Yeah. So with this, we complete different methods of inventory valuation under historical cost. We have done FIFO, LIFO, and weighted average. Now let us try to understand non-historical cost method. See, under non-historical cost, we have just one method which is called adjusted selling price method. Now, what is this method? Let me give a small example to understand the concept, then we'll do a problem. Let's say we have opening stock 3 lakh, then we made a purchases, let's say 5 lakh. So totally 8 lakhs worth of goods. This is the cost of goods available with me. 8 lakhs is available. Now let's say out of this 8 lakh, we sold some item, sales value is 9 lakh. And the remaining item is lying in the closing stock. The selling price of that closing stock is 1 lakh. So can we say out of 8 lakhs, we sold some portion for 9 lakh. Closing stock can be sold for 1 lakh. It's not at sold. That can be sold for 1 lakh. So can we say, had I sold everything, the total sale value would have been 10 lakh. So the total cost of the item is 8 lakh. The total sale value is 10 lakh. Which means, had I sold the entire item, my profit would have been 2 lakhs. See, 2 lakhs I haven't made. 2 lakhs is what I could have made provided I sell everything. So therefore, can we say our gross profit ratio would be 2 lakhs upon 10 lakhs, 20% on my sales. Okay. Now, if I want to find out the closing stock value, we already know the selling price of the closing stock is 1 lakh. Selling price of the closing stock is 1 lakh. But in the balance sheet, we cannot show what selling price now. We need to show what cost price. So from 1 lakh, I'll remove that gross profit. We are calculated 20%. Remove 20,000. So in the balance sheet, my closing stock will be valued at 80,000. Which means under adjusted selling price method, we will find out the closing stock value by removing the gross profit from the selling price of the closing stock. I hope all of you are clear. Now let us take up a question and do it under his non-historical cost method, that is adjusted selling price. Yeah, let's have a look at this question. It's given to you. XYZ is in retail business. They got goods from supplier. So 15 lakh 75,500. This is their purchase, which is subject to trade discount of 3%, sales tax of 11%. So trade discount, I've removed 3%, sales tax, I've added 11%. So after removing the 3% and adding the tax, this will be the final purchases. Next, packing and transportation. See, that is directly related to bringing the item to your present location. So add that packing and transportation. Finally, 17 lakh 83,841 will be your gross purchases. Okay. Now they gave you sales during the year is 22,45,500. Selling price of the closing stock is 235. If I add these two, that will give me the total sale value 24,8,500. This is what I can sell everything for. Now take the difference between the total sale value of the entire item and the total cost 17 lakh 83,841. So can we say this is the profit? So that 6,96,659 is the profit we could have made if I had sold everything. And that divided by 24 lakh 85 into 100 will give you 28.09%. This will be your gross profit ratio. Now find out the closing stock value. And how do you find out the closing stock value? Can I say sale value minus GP ratio? So we know the sale value is 2,35,000. From there, I'll remove gross profit ratio 28.09%. and that will give me the closing stock value. This is what we show in the balance sheet. Clear? Okay, now we'll move on to the next concept in inventory valuation, which is very, very important from examination point of view. That is stock taking. What is the meaning of stock taking? See, this refers to physically evaluating the stock for the purpose of preparing the balance sheet. Now, let's say it's a huge company. You wanted to physically verify the entire stock, and I want to prepare balance sheet on 31st March. So normally what these people do, they start the counting process a little earlier. Let's say the counting starts on 27th March, but they are not able to complete the counting by 31st March. The counting got over only on 3rd of April. So the balance sheet date is 31st March. But stock taking got completed on 3rd of April. And let's say on 3rd of April, in the go down, physically there is a stock of 40 lakhs. Now, this 40 lakhs cannot appear in the balance sheet because a balance sheet is made on a particular date now, which means on 31st March, I need to find out what is the value of the closing stock. This 40 lakhs is there on 3rd of April. So now what we'll do, between these two dates, if there's any transaction, the impact need to be reversed. Let's say there is a purchase of 7 lakh between these two dates. So can we say this 7 lakhs you bought only after 31st of March? So as on 31st March, I'm not the owner of this item. I'll remove the 7 lakh. And let's say during this period, cost of the goods sold, there is 1 lakh. So this 1 lakh, if I had sold after 31st March, can I say as on 31st March, I'm the owner of the item? And if I'm the owner of the item, that item should come in the balance sheet. Which means as on 31st March, I'll be showing how much? 34 lakh. This is what will come in the balance sheet. Which is in this example, my stock taking got over on 3rd of April. From 3rd of April, I want to find out 31st March value. So I'm doing backward calculation or reverse calculation. And whenever we do any backward calculation, inflows we are going to minus, outflows we are going to add. This is a simple basic common sense. So when I'm doing backward calculation, inflows will be deducted, outflows will be added. Same way, let's say in this question only, on 29th March itself, the counting is over. The stock taking is completed. Now from 29th March, I want to find out 31st March value. Now I have to do forward calculation. If I'm doing forward calculation, the calculation would have been opposite. Any inflows I would add it, any outflows I'm going to minus it and find out the closing stock value as on the balance sheet date. Which means from examination point of view, there are two possibilities. First one, stock taking got over after the balance sheet. And you need to find out the value on the balance sheet date. Now, in that case, you have to do reverse calculation. And when you do reverse calculation, if you have any inflows, you're going to minus. If you have any outflows, you're going to add back. This is case number one. Similarly, there can be one more case where stock taking got over before balance sheet. So if the stock taking gets over before the balance sheet date only, now we have to do forward calculation. It's like, for example, I have to go from 29th of March to 31st of March. And when I'm doing forward calculation, it's going to be normal calculation. Any inflows, I'm going to add it. Any outflows, we're going to minus it. So the point you need to keep in mind, stock taking means physically counting the stock. Sometimes it may get over after the balance sheet. Sometimes it may get over before the balance sheet. But our focus is we need to find out on the balance sheet date how much is that. This is one concept that you need to understand. And before solving the problems, there is one more concept that you need to keep in mind. That is, what is the meaning of physical value of the stock and book value of the stock? So can we say physical value is nothing but whatever stock is there in our godown? And book value of the stock is nothing but whatever I'm supposed to show in my balance sheet. Now let's give an example. Let's say goods sold but not delivered. So if you have sold the goods, but if it is not yet delivered, can I say the item is still in my godown? So it's a part of the physical value of the stock. So if I'm calculating physical value, this item is there in the godown. The same item, since the item is already sold, can we say ownership is transferred? But if the ownership is transferred, even though item is physically present with me, I cannot show in the balance sheet. So can I say it's not a part of book value? Which means the book value is based on ownership of the item. If you're owner of the item will come in your balance sheet, even though it is not physically lying with you. Let me give one more example. Goods sent to agent, which is lying unsold. So if the goods are sent to the agent, can I say it's not there in the godown? So physically it is not there. But if it is lying unsold with the agent, can I say I'm the owner of that item? If I'm the owner, it's a part of my book value that should come in the balance sheet. Which means whenever I say book value, our focus is mainly on ownership. It's not on the physical possession of the item. We focus on the ownership of the item. Okay. So just keep this in the mind. For doing problems, all these concepts are very much relevant. And there is one more very important concept, inventory valuation principle. See, as per accounting standard 2, inventory should be valued at cost price or net realizable value, whichever is lower. So I'm sure all of you have an idea what is the meaning of cost and what is NRV. So I'll just quickly summarize. Cost of the inventory is nothing but cost of purchasing the inventory and also the cost of conversion of the inventory. When we say cost of purchase, it covers all expenses that you incur to bring the inventory to your present location and present condition. In simple words, till the item reaches my godown, whatever I spend, like freight inward, carriage inward, loading expense, unloading expense, transit insurance, all that. And once the raw material reaches into my godown, expenses for conversion of that. Cost of conversion can be direct labor, direct expenses, production overheads, all that. So that way you need to find out the cost of the inventory. This cost you need to compare with the net realizable value. See, this net realizable value is nothing but expected selling price of the item from which you minus expected selling expenses if there are any. This is called net realizable value. Compare cost and NRV and take whichever is lower, and that is the principle for inventory valuation. So this is strictly based on conservatism concept. So you should be taking closing stock at whichever value that is lower. Now, keeping all these concepts in the mind, let's start trying few more questions. So now have a look at this question. From the following particulars, ascertain the value of inventories. They're asking you inventory value on 31st March. So can I say closing stock calculation we need to do. Inventory on 1st of April. Opening stock is given to me 1,42,500. Purchase is given. Manufacturing expense is given is a direct expense. Selling expense I'll ignore. Administrative expense, financial charges. All these are indirect expenses. P&L items I'm going to ignore. Because if I have to do closing stock calculation, I'll just prepare trading account and find it as a balancing figure. Sales is given to me for like 45. At the time of valuing the inventory on 31st March 19, there's nothing but closing stock of the last year. 17,500 was written off. Can I say written off is nothing but eliminated on a particular item whose original cost is 50,000. So can we say if out of the 50,000, if 17,500 was eliminated, we would have valued that item at 32,500. So when your closing stock valuation of the previous year, 50,000 item was valued at only 32,500. So maybe this item is a damaged item or out of fashion item. Therefore, instead of valuing at cost of 50,000, they have valued that item at 32,500. Okay, so can I say it's an abnormal item? So what I'll do, this opening stock 142,500, I'll divide into normal item, abnormal item. How much is abnormal now? 32,500. The remaining 1,10,000 is normal. And this item is ultimately sold during the year for 45,000. So what I will do, this 12 lakh 45 sales is given now. This again will divide into normal sales, abnormal sales. So abnormal we know is 45,000. So remaining 12 lakhs will be normal. So let us quickly prepare trading account. So we know opening stock, abnormal item is 32,500. Total we know 142,500. So normal opening stock will be 1 time. That is 1 lakh 42,500. Next, purchase is given directly 7 lakh 62,500. Manufacturing expenses given 1.5 lakh. Sales we know abnormal is 45,000, normal is 12 lakh. Total sales is 12 lakh 45. Now in the question they're asking me to find out closing stock. To find out closing stock, what we need first, gross profit. Now it's given to you. Barring the transaction relating to this abnormal item, gross profit is 20% on the sales. So can we say, except for this abnormal item, for the remaining item, what is the GP ratio? 20%. So what is the remaining sales here? 12 lakh on that 20%, which is nothing but 2 lakh 40. Plus, if you look at the abnormal item, on the debit side, we are showing at 32,500. On the credit side, we are showing that at 45,000. So an item valued 32,500 is sold at 45,000. So can you say there's a profit of 12,500 here? Simplify that. So your gross profit should be 2,52,500. Now just balance this trading account. That should give you the closing stock value. The final closing stock should be 62,500 rupees. Clear? Let's move on to the next question. Some good adjustments are there in this question also. Inventory taking for the year ending 31st March 2020 was completed by 10th April. So that is after the balance sheet date. So we'll be doing reverse calculation. The valuation of which showed an inventory figure of 16,75,000 at cost. So we know 10th April we have 16,75,000 in the go down and this is at cost. Okay. After the end of accounting year till the stock taking date, sales is given to you 68,750 with a profit margin of 33.33% on cost. So can we say 1 by 3 on cost? When the profit is 1 by 3 on cost, it's going to be 1 by 4 on sales. The shortcuts you need to understand and remember, which I've discussed already in the previous video. Okay. Similarly, if it is 1 by 7 on cost, it's going to be 1 by 8 on sales. Okay. It's given to you purchases during the period is 90,000 at cost, 10% trade discount. So if I remove 10%, 81,000 is the purchase. During this period, goods were added to the inventory at a markup price of 3,000 sales returns. Okay. So sales returns is given to us. After inventory taking, it was found that some more slow moving item, some story is given. Let us take up one by one. First thing, how much is the sales made? 68,750. In that 3000 is returned. So can we say net sales 65,750. This is what I've sold net sales. In that sales, we have a gross profit of 1 by 3 on cost. So it is 1 by 3 on cost. Can I say it's going to be 1 by 4 on the sales? So I'll find out 1 by 4 of the sales. Profit will be 16,438. So the cost of the goods sold is 49,312. So this cost of the goods sold, when did you sell this item after 31st March? So if I've sold this item after 31st March, as on 31st March, we are the owners. And if we are the owners as on 31st March, that should come in my balance sheet. So what I'll do, I'll add back this item. But while adding back the item, don't add the selling price of the item. I should add the cost of the goods that you have sold. Because when the item was in my godown, the item was not at the selling price now. It has to be at the cost price only. Yeah, this is the first one. Next one, you made a purchase of 90,000, 10% discount. So can I say 81,000 is what? This 81,000 you bought after 31st March, which means as on 31st March, this item was not there with you. So I'll remove the purchases. So remove 81,000 because I am not the owner of this item as on 31st of March. Next. After inventory taking, it was found that there were old slow moving item. Slow moving item is nothing but outdated or out of fashion item costing 11,250, which should be taken at 5,250 to ensure disposal to an interested customer. Can we say this is NRV of the item? So cost is 11,250. So you're valued at cost only now. But this item I should take at 5,250 because NRV is lower. So from 11,250, I should bring the item to 5,250, which is what is the difference? 6,000 rupees I'm going to remove. So let me explain this once again. So the cost of the item is 11,250 and we have valued it at cost only now. But the NRV is only 5,250. From 11,250, I should bring it down to 5,250, which means 6,000 rupees need to be removed. Remove that. Next one. Due to heavy flood, there are certain goods costing 15,500, which are received from the supplier beyond the delivery date of the customer. As a result of this, customer refused to take the delivery and NRV of this item on the balance sheet date is only 12,000. So we bought the item at 15,500, but the NRV is only 12,500. So we valued the item at cost. Because the NRV is lower from the cost, I should bring it down to NRV, which means that 3,000 rupees, the difference between cost and NRV, I'll remove from here. So can we say finally, the inventory value in the balance sheet should be 16 lakh 34,312. This is what will appear in the balance sheet. Okay. So we'll move on to the next question. Again, a very, very important question. Some good adjustments are there. The profit and loss account of Hanuman showed a net profit of 6 lakhs. Okay, already P&L is made. After considering the closing stock as 3 lakhs 75. Okay. Subsequently, following information is obtained on scrutiny of the books of accounts. Some errors are given to you. They're asking you find out the value of stock on 31st March and also find out the adjusted net. There's nothing but the correct net profit. What is the net profit given in the question? 6 lakh. Now let us take them one by one. Purchase for the year include 15,000 paid for electrical fittings. So when you purchase electrical fittings, it's a capital expenditure. We should go to balance sheet. But that they have included where in the purchase. Because of that, your purchase has gone up, your profit would have come down. So what should I do to rectify? I will add back this 15,000. Okay, next one. Hanuman gave away goods valued 40,000 as a free sample for which no entry was made. See, can we say free sample is nothing but goods given as advertisement? When goods are given as advertisement, there should be two effects for that. See, effect number one, in trading account, I should minus from purchase. Because no entry was made, we did not minus from purchase. And when you don't minus from purchase, your purchase will go up. And because the purchase has gone up, your profit would have reduced. So what we should do? Add what? This is effect number one. Effect number two, the same advertisement free sample should have been debited to P&L. Since no entry was made, you have not taken that in profit and loss account debit side. And because advertisement was not taken at all, your profit would have increased. And how do you rectify that now? Minus 40. So effectively for this particular point, there's no impact need to be given. 40,000 add and 40,000 minus, no impact. Next one. Invoice for goods amounting to 2.5 lakh have been entered. So nothing but purchases recorded on 27th March. But the goods were not included in the stock. So can I say it's an unrecorded closing stock? So closing stock is not recorded now. So because of that, unnecessarily profit would have reduced. So what you're going to do now? Add 2.5. Stock is not recorded, now you do it. So when you record the closing stock, your profit will increase. Next one. In March 2020, goods sold for 2 lakhs. Delivered also, but this is taken in the sales of April. So if you have sold the item in the month of March, I should have recognized in March only now. But instead of recognizing in the month of March, they are recognizing that in the month of April. So can we say sales is not recorded in March only? And because sales is not recognized in March, your profit would have reduced. So what I should do now? Add the 2 lakhs. Next one. Goods costing 75,000 is sold on approval basis. And what is the profit margin? 1/3 on cost. So 75,000 on that 1 by 3, 25,000 margin. So for 25,000 profit, we have sold this item, which means selling price will be 1 lakh. Though the approval is given in April, these were taken as sales for March only. So if the approval is given in April, sales also I should recognize in April only. But instead of recognizing in April, they are recognizing in the month of March itself. So because you are recognized in the month of March itself, can I say 25,000 profit is getting booked in March only? But ideally, that profit should come in the month of April. But you are booking in the month of March. So since my profit has gone up unnecessarily, I'll remove that 25,000 rupee profit. See, if you look at the study material, they would have done it different. Instead of minusing 25, they would have deducted 1 lakh, added back 75,000. The impact is same, so directly taken the profit part. Remove that. Simplify this. That should give you the correct net profit or adjusted net profit. Okay. Coming to the second part of the question, they're also asking you value of stock. If you look at the question, how much closing stock they have considered? 3,75,000. And if you see somewhere here, yeah, here, we made a purchase of 2.5 lakh, but it is not included in the closing stock. So unrecorded closing stock, add that 2.5. And apart from that, we sold some items on approval basis now. This item was approved only in April. So if it is approved in April, when I prepare my balance sheet in March, that item should come in the books of accounts. So I'll add that item also. But while adding that item, it has to be at cost 75,000. Add that. So finally, 7 lakhs is the closing stock. I'll show in my books. Okay. So with this, we complete A quick revision of inventory valuation, various topics, and I've tried to solve few questions also. So please practice few more questions on this topic.